Happy Monday. This week is proving to be very eventful for multiple reasons. So outside of the fact that I told you last week this week was going to be a big week, I wasn't telling you that because I had a feeling that Silicon Valley Bank and Signature Bank were going to be the second and third largest bank failures in history, but that just got added to the list. So not only do we have that happening, we have the jobs report coming out, we have inflation numbers coming out this week. So March is shaping up to be a very, very important time, a very, very important month. So we will hear more about that later this week. Obviously, SVP and Signature Bank failing or going down is huge news for everyone because it will have impacts on lending for us. In fact, as you saw, or maybe you didn't see, Treasuries took a huge dive this morning, which is great for us with rates. That being said, a lot of our lenders increased their spreads a little bit. So let's say the 7-year Treasury went down about 40 basis points. Lenders raised their spreads about 20 basis points. So you definitely are saving on the rate, but lenders increase their spreads accordingly. And part of that is because banks are having to look at their books right now. What do they have? What are their deposits looking like? How healthy are they? Like, this is a huge slap in the face for banks, and they know that they're going to be scrutinized more now that this has happened on top of that. So they want to stay healthy. So some of our lenders, instead of just completely scaling back from lending, increase their spreads a little bit, buys them a little bit of time while they look at things, gives them a little bit of a cushion. So this is what's happening. I do anticipate that banks are going to start scaling back. In fact, one of our owner user lenders today that is known to do some of the tough, more gritty deals, the deals that other banks don't want to do, they just lost that capability today. So they basically had a certain relationship with an investor that allowed them to do more of these kind of, tougher deals or more risky deals, and they lost that today. So they're not going to be doing those loans anymore. And we're going to see this happen more and more. And the problem with this is SVP and Signature Bank failing is just showing small regional banks that they're basically at a risk right now because people were lining up out the door of their small regional bank to pull their money out to move it to one of the top 4 or 5 banks, or to spread their money across multiple banks because they're scared that what if the Fed doesn't cover these deposits? What are we going to do? We don't want to lose our money. Obviously, you think that when you put your money in the bank that it's actually safe, or you should think so, because it's basically gaining virtually zero interest. So you're not really making an investment. You're just having your money held in this account, right? So people don't feel safe with their money, so people were lining up to take their money out of the banks. Hopefully some people have settled down on that now that the Fed has decided to cover all of the deposits that were in those banks that failed. They are covering all of those deposits so people can make their payroll, people can make their mortgage payments and things like that. So that's really good news, but it definitely shook the industry. It feels very, very 2008, except for real estate's not getting hit as hard this time around. It's tech. And so I do anticipate that some of our lenders are going to get more conservative because this is just kind of like a ringing of the bell that the recession is here. And on top of all of that, the Fed is supposed to speak next, or is supposed to meet next week, which a lot of people were saying for sure they're going to be raising prime. Now I'm not so sure because this bank failure is catastrophic enough that it might convince the Fed that they don't need to raise anymore. Why? Because if they don't want to see more banks fail, and they don't want to see more pain in the economy than we've already had, and they're already seeing signs of the job market slowing, banks failing, inflation may come out a little lower. These are all the signs that raising rates has had an impact. In fact, it's had a significant impact. So maybe they will finally not raise prime. I do think that we have a pretty good chance of that happening. But that remains to be seen. So that is the news for this week. It is all over the place. So I'm sure everybody's heard about these bank failures. If you haven't, I don't know, maybe you're on vacation or something, but this is pretty huge news. I anticipate getting more and more news as the week goes on with our various lenders. The market is super volatile, but I think the thing to note here is that for every bad piece of news that happens, there is always opportunities that are born, right? So, for example, the bank stocks tanked because of this news. So a lot of people are going in and buying bank stocks. In fact, First Republic was one of them. They actually had to halt trading this morning shortly after opening because so many people were trying to buy the stock. I don't know if it's been reopened yet or not, but that's what I heard because I was also buying some bank stocks. But so there are opportunities to make money. Things are going on sale. Assets are going on sale. So this is an opportunity if you can be quick to not feed into all the hype and to look at where the opportunities are, shift your energy there, and make some money on some of this very tough news that has come out. So have a great week, everybody. If you have any questions, feel free to reach out to me, any scenarios. I will be happy to help all of you.